Hello folks, Steve Lance here with Discover Options, and welcome to this edition of various market timing reports. This is for Friday, May 19th, getting ready for Monday, the 22nd. Presented materials for educational purposes only, should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. Folks, if you are a Condor trader or a butterfly trader, we have a timing report that will help you determine whether now is a good time to get into those strategies. I'm adding also this time a bull put spread timing report, and then the statistical based directional likelihood report as well, all for the S&P 500. Let's go over here and take a look at the market condition. We have the S&P, of course, it had a huge gap down on Thursday, a huge downswing bar. We had then another downswing bar after that, and then followed by Wednesday was a downswing, Thursday was a downswing, and then also Friday was an upswing bar. Finished above the 50-day moving average. The stochastic 15.3 is down there around 27 or so, but it's between 10 and 50 underneath the moving average, the percent D. That's a very unique market condition. Doesn't happen that much where you have price above the 50-day average with stochastic down that low and still below its the percent D. Kind of unusual. This market condition has not even occurred 50 times since Jan of 2000. Kind of unusual. So let's go to the first. Now I'm just going to show you the reports. We're not going to get into methodology here today. I've done that so many times in the past. The recordings are available, etc. But let's take a look. For those of you trading condors and butters, the question is now a good time to implement a condor or a butterfly? And the answer is there's a small negative edge right now. If you like to just trade through no matter what the market conditions are, that's fine. Just be aware that you have a slight negative edge relative to what's normal out there in terms of flipping a coin and getting a favorable bar for doing this. So here's the report. Since Jan of 2000, there have been over 4,300 daily closes of the SPX. Of those 4,300 and how many? 37. 65.1% have been favorable bars for selling premium, where the actual 21 bar movement was less than the SIBO skew adjusted implied movement. Okay, that's what a favorable bar would be. Also during that time, the current market condition that I just showed you has occurred 48 times. Of those 48 occurrences, 62.5% of the bars have been similarly favorable for option premium selling. Now that implies a selling edge, it's very small, of a negative 2.6%. I mean, the benchmark, you could flip a coin and get a favorable bar, or you can, 65% of the time. Of the market condition, of the 48 times our market conditions occurred in the past, 62.5% of those have been favorable. So there's a slight negative edge here, okay? So statistically, it's slightly more likely than usual that Friday's bar will end up being unfavorable for, slightly up, being up more unfavorable for market neutral option premium selling. Okay? So it's very, very close to the benchmark. It can go either way pretty well. Nothing to hugely hang your hat on. You could flip a coin, and 65% of the time you'll end up putting on a condor or butterfly where the market doesn't move as much as it was implied. Okay, under our current market condition, it's almost that, but not quite. All right, let's go to the bull put spread timing report. This is where we're selling out of the money put premium 30 days out. All right, and that's the scenario we're talking about here. So here's the report. So since Jan of 2000, again, there's been over 4,300 daily closes. Now of those, 82.7% have been favorable ones for selling put premium, where the actual 21 bar downside movement was less than the SIBO skew adjusted implied movement to the downside. So in a bull put spread, we're contemplating selling out of the money puts and then buying further out of the money puts to cover that, right? And creating a credit spread. We're selling these at a standard deviation out of the money, and what we're saying here is you could flip a coin, and 82.7% of the time you'll pick a bar where the ensuing 21 bar movement, 30 days, calendar days, 21 trading days, the ensuing 21 bar movement such that it does not go down that far. Okay, the other, what is it, 17.3% of the time, it does go down that far or more and touches that standard deviation level. So that's the benchmark at 82.7. Now during that time, our current condition that I just showed you has occurred 48 times. Now of those 48 times, 83.3% of the bars have been favorable for selling put premium, out of the money put premium. Now that implies a put option premium selling edge of plus 0.6%. Again, very, very close. Very, very close to the benchmark. No huge advantage here. No big disadvantage with our current condition. But I think it's kind of helpful for you to know going into this that you pretty much have the same edge you would normally have trading in the S&P 500 options market. Statistically, it's more likely than usual that today's bar or Fridays will end up being favorable for selling out of the money put premium. So those are the two premium selling reports. Let's now go to the likelihood report. And what we're looking at here is just a grid of numbers. And what we do is look at the distribution of price. Okay, we're not looking at implied volatility at all. All right, we're looking at the distribution of price and how it normally is compared to what it would be with what our market condition is right now. So, and what we do is we set up 6 different distribution bands. These are set up 5 days in the future and 1 standard deviation above the close, 10 days in the future and 1 standard deviation above the close, and then 15 days in the future, a standard deviation above the close. And then we go out 5, 10, and 15 days, putting these below the close. Okay, so look at the historical distribution here. Over 4,337 closes going back to Jan of 2000. Of those 4,300 plus, 29.5% of the time, price does go up and hit the 5-day 1 standard deviation level up there. Okay, the rest of the time, the other 70.5% of the time, it fails to hit that 5-day 1 standard deviation level above the closing price. Okay, moving forward 5 days. It hits the upper 10-day 1 standard deviation level, 23.3, the upper 15, 23.2, and then to the downside, the market has hit the downside 5, 10, and 15-day standard deviation levels a bit more often, 29.3, 28.9, 31.8. So this is kind of expected the rest of the time. So, I mean, you could just look here on the upper and the lower 5-day bands. The bands are getting struck almost 60% of the time. The other 40%, the market wobbles around and doesn't hit either of the bands. So this is kind of an expected, what you would expect the market, how it behaves. Now, if we have a current market condition, all right, that results in the upper bands getting struck 100% of the time and the lower bands getting struck 0% of the time, well, we would conclude that's a very, very bullish market condition, right? What if we discovered that a market condition develops where, when we look at the past, it turns out that the lower bands were struck 100% of the time and the upper bands were never struck? Well, that would be a hugely bearish situation. So let's see for our, and this is 49 including consecutive signals. of the 49 occurrences, all right, going back to Jan of 2000, of our market condition, of those 49, the ensuing price action struck the upper 5-day 1 standard deviation band 28.6, pretty darn close to the benchmark. It struck the upper 10-day 1 standard deviation band 30.6, which is more than the 23.3. So this is kind of an indication of a bullish nature, and the 15-day band was struck also more often than benchmark. So these blue numbers here are indicative of a bullishness, that this market condition ends up resulting in the upper bands getting struck a bit more often than normal. Likewise, the lower bands, well, the 5-day is struck about the same. The lower 10-day 1 standard deviation level is struck less often. Again, now we're leaning towards the bullishness, and the 15-day band is a wash. So altogether, of those 49 closes going back in the past, we have a bullish bias here slightly. Does it mean it's going to go up? Well, no. The lower bands have been struck, you know, over almost 25% of the time. So we're talking about just likelihoods here. Likelihoods. There's a slightly greater than normal likelihood that this condition we have now would result in a bullish distribution. There's been a more bullish distribution of prices. Okay, now, what if price exceeds Friday's high? What's the distribution been after Friday's high gets exceeded? Okay, the previous day's high was exceeded 25 times. After our condition is developed, the high has been exceeded 25 times. And when that happens, the distribution is kind of a wash. You have the benchmarks getting, you can see it's getting, the 5 is hitting less often, a little bit more often. On the lower side, lower bands, less often, about a wash. So I'm going to call this a wash. But now look what happens. If price exceeds the low, like from Friday, if price goes below Friday's low, then from that point of the Friday's low, from that point, you move out 5, 10, and 15-day 1 standard deviations to the upside. Those bands are getting struck more often, and the lower bands are getting struck far less often. Definitely a bullish situation there, a greater likelihood of bullishness. The distribution of price has been leaning to the bullish side then, okay? So that is the report on the likelihoods, as well as for the Condor, butterfly, and bull put spreads. I hope this information has been helpful to you. And let me get back to this screen here. Oh, I'm sorry. I like to readjust those bands using skew adjusted VIX, and honestly, similar thing you have here. You have a bullish bias on the distribution as of the close. It's a wash if price goes above the high on Friday, and then it's definitely leaning bullish if it goes below the low. Okay, just wanted to point that out. Folks, thanks for joining me today. We'll see you next time. Have a great rest of the week. Just have a great time trading this week, okay? Take care. Bye-bye.